too negative?
Look at the market. I mean, I think probably, but you know, it is quite normal for, particularly around an earnings season, people talk down the numbers because all you're doing is you're setting expectations even lower, and it doesn't take much to beat those. And we kind of have seen that. I mean, some of the earnings out this morning, for instance, Philips, actually okay, pretty good shares rallying on the back of it. So I think there is a lot of pessimism out there, but maybe looking at the numbers, so to speak, and I know we've had more downgrades than upgrades, but maybe the numbers are telling a bit of a different story.
So how much more adjustment of full year expectations do you think we're going to see?
I still think, you know, if you look at actually where we are, I mean, in terms of risk appetite, I mean, it is actually still fairly strong. If you look at all the negatives that we've seen over the last couple of months, we have seen willing buyers to come in and pick stocks up as soon as they sell off 5 or 10%. You know, and as long as we keep that momentum going, then I still think we're looking fairly optimistic towards the end of the year.
And what is the lag between economic pickup and earnings pickup longer than normal at the moment? Is that one of the reasons we're seeing this?
I actually think it's a bit. The one thing I would say is when you look at economic data, everyone's looking at data and they're looking at stimulus, they're looking at QE, they're looking at the Fed, they're looking at the Bank of England, they're looking at reaction from the ECB, and they're looking at currency moves, because that's where we're seeing a big move from this. And we've seen some of that as well. Of course, you look at currency exposures in terms of implicating the actual numbers themselves. So I still think that the actual time frame from when you're looking at data to stocks is actually shorter than where it was maybe 6 months ago, but it's a bit blindsided because people are looking more towards stimulus than necessarily fundamental earnings.
Just looking through the list of some of these warnings we've had, materials firms, diversified financials, tech hardware. What sectors would you stay away from with, you know, in hindsight now, I guess?
I still think the China story for me is still a relatively concerning. I know we had some decent pickup in the GDP side of it from an import perspective, and that's where most people are focusing on, the imports as opposed to the weakening exports. But I still think that's a very volatile area at the moment to be putting investment funds into. We have seen a bit more of a diversification in terms of some of the raw materials and mining stocks that we've seen from our clients over the last month or so. So for me, it's more about looking at the banks and financials is where we're actually seeing a lot of flows coming into. That and pharmaceuticals as well, where we've got a sector which is actually consolidating relatively strongly at the moment.
Citi and JP Morgan, of course, we just had this, the JP Morgan news. I mean, you talk about that financials. What kind of hit generally, globally, in Europe are we going to get from all of this?
Well, I mean, you're looking at it from the investment banking side of it. That's where most people are looking at the numbers side. So the one thing I would say is when you look at those companies and when you look at those big US corporates when they're reporting, try and divorce the legal costs and where you look at in terms of like settlements, for instance, from a regulatory perspective, because if you divorce that side of it, actually the numbers look fairly strong. So fundamentally, I think there's a lot of things to be optimistic there.
Just to finish up, what message are you telling your clients about this earnings season?
Try and look at the numbers and try not to get necessarily a little bit taken away by the whole stimulus program. And we got obviously payrolls out later on as well. So, you know, it's very easy to forget about the actual corporate fundamentals and look purely at going with the trend. And that's what a lot of our clients are doing. To be fair, they've been doing it quite well, so it's hard not to dissuade them from that.
Actually, and to come